How to improve your credit score. Welcome to our channel. In today's video, we're going to talk about how to improve your credit score. Your credit score is a 3-digit number that represents your credit worthiness and is used by lenders to decide whether to grant you a loan or credit card at a certain interest rate. A higher credit score can make it easier to get approved for a loan and result in lower interest rates, while a lower credit score can make it harder to get approved and result in higher interest rates. There are several factors that contribute to your credit score, including payment history. This is the most important factor in your credit score and accounts for about 35% of your score. It reflects whether you have made your payments on time and in full. Credit utilization. This is the percentage of your credit limit that you use. It accounts for about 30% of your score and is considered a key factor in determining your credit worthiness. Lenders like to see low credit utilization, so it is important that your balance is below 30% of your credit limit. Length of credit history. This is the period of time you have had credit accounts. It accounts for about 15% of your score and generally has a positive impact on your credit score if you have a long credit history. Credit mix. This refers to the type of credit you have, such as mortgage, car loan, and credit card. Having a mix of credit types can have a positive impact on your credit score because it shows that you can manage different types of credit responsibly. If you like this video, we appreciate a thumbs up and you subscribing to our channel. In the US, the credit worthiness of a person or business is typically measured by credit scores, which are produced by credit bureaus such as Experian, Equifax, and TransUnion. A credit score is a number based on information in a person's or company's credit report, and is used to predict the likelihood that they will meet their credit obligations. In the US, credit scores are typically rated on a scale of 300 to 850, with higher scores considered better. In Germany, for example, the credit worthiness of an individual or company is often measured by SCHUFA information. SCHUFA uses information to create a SCHUFA report, which is used by banks, insurance companies, and other lenders to assess the creditworthiness of an individual or business. In Germany, there is no set scale as there is in the US, but the SCHUFA report usually contains a rating for good to very poor that reflects the creditworthiness of a person or business. As a rule, the credit score is a numerical value, which means the higher the value, the lower the probability of default for the lender. Depending on the country, there is an option to query one's current credit rating on an annual basis. The commissioned companies are obliged to provide a free report. You should do this in any case, because this way you can indicate possible errors for modification. The companies are then obliged to delete the errors. This can amount to the percentage you need to get your loan. 1. Pay your bills on time. Payment history is the most important factor for your credit score, so it is important that you pay all your bills on time. Set up automatic payments or reminders to keep you on track. Also, make sure you always have enough money in your account so it's covered. Interest rates are much higher on an overdrawn account, and it permanently damages your credit score. Keep your credit utilization low. Credit utilization is the percentage of your credit limit that you use. Lenders care about low credit utilization. Try to keep your balance below 30% of your credit limit. 3. Don't open too many accounts at once. Opening too many new accounts in a short period of time can negatively affect your credit score, as it may appear that you are trying to borrow too much money. 4. Check your credit report for errors. Make sure your credit report is accurate and up to date. You can get a free copy of your credit report once a year from each of the 3 major credit reporting agencies: Experian, Equifax, and TransUnion. Depending on the country, there are institutions that have to offer this. The bank, for example, then asks the data about you before a loan from the institution. It is also important for you to know which stores where you store deposits their data with the institution. 5. Consider a credit building loan. A credit building loan is a small loan with a low credit limit to help you build or rebuild your credit score. If you repay the loan on time, you can improve your credit score. Absurdly, then, it's better to have paid off a loan reliably before than to have never taken out a loan. Your credit score goes up if you've already been a reliable borrower. Therefore, it can actually help if you take out a loan with low interest rates and repay it on time, even if you don't need the loan. 6. Don't close old credit card accounts, and keep them active. Closing old credit card accounts can lower your credit score because it reduces the average age of your credit accounts. The longer you've reliably serviced credit or had an account in the positive numbers, the better for you. Even if you don't use an old credit card, keep it open and active by using it occasionally and paying off the balance in full. For example, you can rotate payments by setting up standing orders that transfer money from one account to another. For example, if you can earn payback points, you should always choose the credit card where you will benefit the most. 7. Use a secured credit card. A secured credit card is a credit card that is secured by a deposit. It can be a good option for building or rebuilding credit, as it allows you to demonstrate your ability to use credit responsibly. 8. Don't apply for too many loans at once. Each loan application will result in a hard inquiry on your credit report, which can negatively impact your credit score. Try to limit the number of credit applications. Generally, you should also only have as many accounts as you actually need. Excess accounts will still need some attention on your part. You can put that time to better use. 9. Don't max out your credit cards. If you max out your credit cards, it can hurt your credit score because it increases your credit utilization and gives the impression that you rely too heavily on credit. 10. Don't co-sign for another person. If you co-sign for another person's credit, it can jeopardize your credit score because you will be responsible for paying off the debt if the other person fails to pay. 11. Two borrowers. The reverse is true. If you apply for a loan and are married, it can make a lot of sense or sometimes even necessary that you both become borrowers. Generally speaking, having a second borrower in the loan agreement increases your credit rating, which also increases your chances of getting a loan with better terms. 12. Use a mix of credit types. A mix of credit types, such as a mortgage, car loan, and credit card, can help improve your credit score. 13. Pay any outstanding collections or write-offs. Outstanding collections or write-offs can hurt your credit score. Make sure you always pay all debts on time and in full. If you don't pay a bill in the appropriate time, then you'll get a reminder. On the second reminder, this usually results in a negative entry regarding your credit rating, and your credit score drops. Therefore, make sure that you always pay your bills promptly and on time. 14. Transfer less than $5,000 in one transfer if possible. Higher amounts of money are subject to monitoring. Therefore, if you transfer large amounts of money frequently, you may end up on a list for more intensive monitoring. Sometimes it is possible that this will lower your credit score. 15. If you have several loans, it helps if you do a debt restructuring. Consolidate all your debts and loans into one loan that has the lowest interest rate, or pay off your debts as soon as possible, in the order that you pay off the loan with the highest interest rates first. It's important to know that improving your credit score takes time and requires consistent effort. It's also important to remember that your credit score is only one factor that lenders consider when evaluating your creditworthiness. Other factors, such as your income and debt-to-income ratio, your available equity, your monthly expenses, the length and type of your employment, and any debt you've already taken on also play a role. So, that's it for today's video on improving your credit score. I hope it was helpful. If you have any questions or ideas for future videos, let us know in the comments below. Thank you so much for watching.